All right, it's January 30th, and if you follow silver at all, stop scrolling for a second and stay with me. In just days, over 30% vanished. We're talking silver dropping from around $121 to under $85 an ounce, fast enough that a lot of people didn't even realize what hit them until the damage was done. And yes, you've probably already seen the headlines blaming Trump's nomination of Kevin Warsh for Fed chair. That mattered. But here's the real thesis, and this is urgent. The nomination didn't cause the collapse, it triggered it. This was a levered, parabolic paper market waiting for a pin. Both JP Morgan and rate markets just confirmed the same thing in different ways. Stay with me, because I'm going to show you how this actually works, how to recognize it next time, and why this isn't over yet. Before I explain what caused this move, let me teach you something most people never learn about silver. Silver doesn't trade like gold. It doesn't even trade like most commodities. Silver is thin, emotional, and highly levered on the paper side. Think of it like a crowded elevator held up by cables made of futures contracts. It can go up smoothly for a while, but once too many people pile in on margin, the whole thing becomes unstable. Most people think price moves because of news. In reality, news just tilts expectations. Leverage does the real damage. That's why silver can look calm for weeks, then lose 20 or 30% before you've had time to react. If you understand that single concept, you're already ahead of most traders watching this right now. And here's what matters. The structure of silver's futures market means it magnifies both directions. Up moves become explosive. Down moves become violent. So what does that tell us? It tells us that when you see silver running hard and fast, you need to be asking yourself one question. How much of this is real demand, and how much is just leverage stacking on top of leverage? If this is making sense, drop a comment below and let me know where you're watching from. Now, here's what's actually happening. Let me break down the sequence because this part matters more than anything else. The Warsh nomination immediately strengthened the dollar and shifted rate expectations. Higher real rates are poison for non-yielding assets like silver. That's the primary driver. When the market thinks rates are heading up and staying up, money flows out of assets that don't pay you to hold them. Silver doesn't pay a dividend. It doesn't pay interest. It just sits there. So when opportunity cost rises, selling pressure builds. That's economics 101. But that alone doesn't explain a 30+% collapse in a matter of days. Here's the cascade, and this is where it gets critical. As silver slipped from those highs near 120, leveraged futures positions started hitting maintenance margin. Traders who bought contracts on margin suddenly got calls from their brokers. Post more cash or we're liquidating your position. That forced selling pushed prices lower, and when prices drop fast, more positions hit their margin requirements, which triggers more forced selling, which pushes prices even lower. You see where this goes? It feeds on itself. That's the paper market eating its own tail. And here's what's wild about this. None of that requires physical selling. Bars didn't flood the market. Vaults didn't suddenly overflow with people dumping their metal. This was paper leverage unwinding in real time. Contracts getting closed, positions getting liquidated, numbers on screens changing hands. But the actual metal? Most of it never moved. Now let me show you the secondary confirmation, because this is where it gets really interesting. While paper silver is flushing down through 90 through 85, physical silver isn't confirming it. Shanghai prices are still hovering near $120 an ounce. That's over a 40% premium to what you're seeing on the COMEX. When price discovery splits like that, when the paper market says one thing and the physical market says something completely different, it doesn't usually resolve quietly. One of two things happens. Either paper drags physical down eventually, or physical pulls paper back up violently. But here's the part that should make you nervous. That spread is telling you the panic is concentrated in the leveraged paper structure, not in actual supply and demand for the metal itself. What you're seeing is a technical liquidation event masquerading as a fundamental repricing. The Warsh news gave the market a reason to sell. Rate expectations gave it an economic justification. But leverage is what gave it the violence. And that convergence, that perfect storm of catalyst plus structure, that's what creates these moves that feel like the floor just dropped out. The people getting hurt worst right now aren't the ones who own physical bars in a vault. They're the ones who are playing with 5 times, 10 times, 20 times leverage thinking silver only goes up. The market just reminded them that volatility cuts both ways. If this feels familiar, that's because it should. This is the exact same playbook silver ran in 2008 and 2011, and again in March of 2020. Each time you had a parabolic run. Each time you had extreme leverage building in the futures market, and each time a macro shock tightened financial conditions and the whole thing unwound. In 2008, silver ran to $21, then collapsed to $8.75. That's nearly 60%. In 2011, silver hit $49 before crashing back to $26. In 2020, it spiked to $18.50, then dropped to $11.75 in about 2 weeks. Every single time, silver collapsed far more than fundamentals justified. And every single time, the paper market broke first. Physical premiums stayed elevated. Dealers couldn't keep inventory. But the futures price just kept falling because leverage was unwinding faster than physical demand could absorb it. Zoom out and you see the larger story. Silver doesn't gently correct excess. It violently resets it. That's the pattern. That's what it does. And if you know that going in, if you understand that's just how this market behaves, you can position yourself accordingly instead of getting caught off guard. Now, I know what some of you are thinking. Could silver really drop to $50? That sounds insane to people anchored to last month's prices when we were above 120. But here's the thing. It's mechanically plausible in the paper market if liquidation continues. Not guaranteed, not predicted, plausible. There's a big difference, and understanding that difference keeps you alive in markets like this. When you've got massive leverage unwinding, prices can overshoot fundamentals by a mile in either direction. Now let me be skeptical for a moment because I want you to hear independent thinking, not just hype. Could this all just be manipulation? People love that explanation. Banks rigging the market, algorithms running stops, coordinated takedowns. Here's the thing. You don't need a conspiracy when incentives and leverage already point in the same direction. Large players hedge their exposure. Funds de-risk when volatility explodes. Algorithms sell when circuit breakers start hitting. That's not manipulation. That's risk management at scale. Does that mean fundamentals are broken? No. It means the paper structure is stressed. And when structure breaks, price follows structure, not fundamentals. The actionable focus for you isn't who to blame. It's what signals to watch so you're not reacting emotionally after the fact. Because honestly, whether this is natural market forces or coordinated intervention, the mechanics are what matter. You can't control the why. You can control how you respond. There are probably 3 types of people watching this right now. First, there's you if you're overexposed and stressed, wondering if you should hit the eject button. Maybe you bought near the top. Maybe you're holding leveraged positions that are deep underwater. Maybe you're watching your account bleed and you're not sure what to do. Let me be honest with you. Panic selling into forced liquidation zones is usually how losses get locked in. I've seen it happen over and over. People hold through the entire run-up, then sell at the absolute worst moment because they can't take the pain anymore. If you don't understand your leverage, reduce it first. Get your position size to a place where you can sleep at night. If you're holding physical with no leverage, your thesis hasn't changed. The metal's still in your hand. But if you're on margin, if you're trading futures, if you're using options, you need to know your risk parameters cold. Because in markets like this, survival comes first. Second, there's you if you've been waiting for a pullback, thinking this is finally your chance. Maybe you missed the run from $80 to $120. Maybe you've been sitting on cash waiting for a better entry. And now you're seeing silver in the mid-80s, and you're thinking about backing up the truck. That might be true. It might be your moment. But timing matters. Catching a falling knife in silver is brutal if the paper unwind isn't finished. You don't want to step in front of a liquidation cascade. So if you're looking to add exposure, do it in stages. Scale in. Don't blow your whole load at 85 if it's heading to 70. Have a plan and stick to it. Third, there's you if you only care about physical metal and long-term fundamentals. You're not trading, you're stacking. You believe in the thesis over years, not weeks. Your conviction hasn't changed, but your patience is being tested. Because watching your stack lose 30% of its paper value in a week is psychologically brutal, even if you know you're not selling. For you, I'd say this. Your thesis hasn't broken. Physical demand hasn't disappeared. Industrial use cases haven't vanished. Solar panels still need silver. Electronics still need silver. The supply deficit story is still intact. What's changed is sentiment and leverage. Those are temporary. For all of you, the universal principle is the same. Respect structure before conviction. Markets don't care how right you feel. They care about positioning, liquidity, and leverage. If you're fighting those forces, you're going to lose. So here's what I want you to answer in the comments. Which type are you? Are you holding through this, scaling in, or waiting on the sidelines? Let me know because I'm genuinely curious how people are positioned right now. So here's where I stand. I'm not chasing panic, and I'm not pretending this is nothing. I'm watching 3 things closely. First, how silver behaves between $85 and $80. If we slice through that zone without any meaningful bounce, that's panic continuation territory. That tells me forced liquidation is still running and there's more downside to come. Second, whether 70 to 75 shows real support if we get there. That range would represent a 50% retracement from the highs, and historically, that's where you've seen major bottoms form in silver. If we get there and buyers show up hard, that would signal a deeper washout is complete. Third, I'm watching physical premiums closely. If they stay above 25%, if Shanghai keeps trading at a massive premium to COMEX, that tells you downside pressure is still paper-driven, not fundamental. It means the real market for metal hasn't broken. It means this is a structural flush, not a demand collapse. Based on my analysis, this collapse was mechanical, not emotional. The Warsh nomination was the match. Rate expectations were the kindling. But leverage was the gasoline. The fundamental picture for silver, the supply deficit, the industrial demand, the monetary debasement thesis, none of that disappeared. What disappeared was leverage. What disappeared was speculative froth. What disappeared was excess positioning. And when you strip that away violently like this, you get moves that look catastrophic but are actually just structure resetting. If history rhymes, and I think it often does in silver, resolution comes violently, not gradually. You get a washout, you get a base, and then you get a move that surprises everyone who thought silver was dead. I'm not a financial advisor. This is not financial advice. Do your own research. Verify everything I've said. Check the data yourself. Look at Shanghai premiums. Look at historical drawdowns. Look at open interest in the futures market. Don't take my word for it. If you made it this far, you're the kind of person who thinks critically instead of reacting emotionally. That mentality will serve you well in markets like this. If this breakdown helped you understand what's actually happening instead of just watching numbers fall, hit that subscribe button. Share this with someone who needs to see it. And stay sharp out there. Verify the data, think critically, and make sure you're positioned, not surprised. All right, it's January 30th, and if you follow silver at all, stop scrolling for a second and stay with me. In just days, over 30% vanished. We're talking silver dropping from around $121 to under $85 an ounce, fast enough that a lot of people didn't even realize what hit them until the damage was done. And yes, you've probably already seen the headlines blaming Trump's nomination of Kevin Warsh for Fed chair. That mattered. But here's the real thesis, and this is urgent. The nomination didn't cause the collapse, it triggered it. This was a levered, parabolic paper market waiting for a pin. Both JP Morgan and rate markets just confirmed the same thing in different ways. Stay with me, because I'm going to show you how this actually works, how to recognize it next time, and why this isn't over yet.